students, I welcome you all for the online class of business studies. Today we will be continuing with the topic, the other source of finance by which capital can be increased by the businessman. Very first is the commercial banks. As we were already learned, these banks also help us to help the businessman to create and to increase the capital for as a source of business, so that they can run their business smoothly. They can provide loan. They can give borrowings to the banks. Keep the information of borrower confidential, and the business can maintain its secrecy with the help of the banks. No formalities of issue of prospectus etc. required if the business people want to raise the capital in the from the by taking loan from the commercial bank. So it is very easy and economical source of fund. Not so much easy, but as it is easy as compared to shares and debentures. It is a very flexible source as loan amount can be increased as well as decreased. When we talk about the limitation of commercial banks, funds are generally available for a short period. Banks made detailed investigation of the company's affairs and financial structure before issue of loans. So this is the limitation of commercial banks, that generally available for what period? Short period of time. They make detailed investigation of the company's affairs and financial structure before issue of loan. In some cases, bank may put restrictions on difficult terms and conditions. Difference between public deposit and loan from commercial bank, when we see the basic difference is, very first, no security required. Bank loans generally require security. Governed by public deposits are run by the Companies Act, whereas banks are run by the regulations of RBI. Rate of interest of public deposits comparatively low, whereas banks loan is generally high. Public deposits are available for a period up to 3 years, but bank deposits are available for short and medium term. Suitable source of finance for companies with good reputation and financial standings are there for the public deposits, but it is suitable for all types of enterprises. Good reputation, and especially government companies, you can have the public deposits. Not for every type of newly started companies. Secrecy point of view, when we see, there is no secrecy in the public deposit, but there is a great secrecy to be maintained by the banks, by the commercial banks. Next, we have gone to the loan from financial institutions. Some of the situation I said to you people, it is also beneficial for government, another institution, to take loan from financial institution. Government also find the banks are not enough to provide loan to all the number of businessmen. So their government find to start some financial institutions which will be regulated by the government and by the RBI, that not completely by RBI, but they will be seeing and regulating over the business of financial institutions. So as per the need of the company, more and more finance, government has started financial institution. They permitted the financial institution must be set up. There are more and more number of private financial institution as compared to government financial institution. The need for public financial institution was felt due to the following reason. First, long-term finance. Financial institution provide long-term finance. Managerial advice, definitely financial institution provide managerial as well as financial advice on various matters. Medium and long-term finance, when we see, public financial institutions provide medium as well as medium and long-term finance to industrial enterprise at a reasonable rate of interest. Subscribers of securities. When we go through this point, financial institutions often subscribe to the shares and debentures of the companies. Underwriters. Financial institutions underwrite the public issue of shares and debentures by companies. Guarantee loan. Financial institutions provide loan guarantees to industrial units from other banks and financial institutions. Loan in foreign currency. Financial institutions provide loan in foreign currency to import machinery. These institutions provide guarantee also for purchase of capital goods from foreign countries. Limitations of financial institutions, when we see, too many formalities have to be fulfilled for taking loan from financial institutions. They may put certain restrictions, such as restrictions on dividend payment, etc. Sometimes financial institutions appoint their income nominees as board of directors to restrict the powers of a company. So these are the disadvantages of financial institutions also. So some of the companies, because of this reason, they don't prefer the financial institution. They prefer the commercial bank for taking loan or other source of finance. Intercorporate deposit. Now comes next. That means one business firm giving help to another business firm. It is known as intercorporate deposit, ICD. It is also type of borrower fund which is of short term, generally source of finance. Generally businessmen help the other businessman for a shorter period of time. If they will be giving the loan for medium term or long term, their business also have to run. So because of that, businessman generally provide short term finance to the other businessman. It is a deposit made by one company with another company. This option of using finance is available to all the public companies whether having share capital or not. It includes when a company acquires security of another company, when a company gives loan to another company, when a company gives guarantee to any person or institution who provides loan to another company. In general, we can say when companies arrange funds from another company, it is known as intercorporate deposit, what I said to. There are three types of intercorporate deposit if we will be seeing. Very first, 3 months deposit. 3 months deposit is that deposit in which this is the most common deposit to overcome the short term finance problem like working capital management problem. The annual rate of interest given for 3 month deposit is 12% per annum. That is very much higher. 6 month deposit, short term finance, they are made for first class borrowers. The annual interest rate is 15%. Call deposit, this can be withdrawn by lender by giving any 1 day notice. Means if they don't want to keep this notice, they can have 1 day notice. That is a call deposit is known like banks generally do call deposit. If banks is not able to manage cash reserve ratio, then they can take the help of another banks for management of this reserve ratio. So for that they can they can make a call to the another banks for 1 day. They can arrange the finance and next day they can return back. The rate of interest is generally 10%. Day wise it is. The biggest advantage of ICD intercorporate deposit is that transactions are free from legal and bureaucratic hassles. International source of finance. The next and the last topic of the source of business is the international. This were the Indian source of increase raising finance in the business. Now we will be going, there are some international sources of finance increase or raising in the business. Prior to 1991, Indian companies were not allowed to raise finance from abroad or from foreign companies. The source of finance were restricted within India. After the new economic policy of liberalization or globalization, the doors of foreign companies and investors were open to invest in the Indian companies. So there came the economic policy 1991. After 1991, the Indian companies can tap international source of finance. That means after liberalization, privatization and globalization, they have started the new way of financing for the business, that is for both debt and equity way. The main securities used by Indian companies to tap international source of finance are very first, loan from commercial banks. Second, international agencies and developmental banks. Third, international capital market, that is ICR. So let us see the loan from commercial bank. We already learned there. The commercial bank gives you loan, offer the loan, and that is prescribed at a prescribed rate. International agencies and developmental banks are also there, which are providing at international level the finance. Beside this, international capital market is there, where we are getting the finance with the help of GDR, ADR and IDR. Loans from commercial banks, when we see borrowed fund, commercial banks are a very popular and common source of medium-term finance for companies. Medium-term loans can be raised by companies against the security of assets. Okay. That means if you want to take the loan, for that you have to give some security like the paper of the offices and the paper of the land likewise. The rate of interest of loan is generally fixed by the RBI, Reserve Bank of India. Nowadays, with the entry of foreign banks and private banks, taking loan from commercial banks has become very simple task. Banks do not interfere in the management of companies, and such loans can be repaid in parts and interest can be saved to that extent. International agencies and developmental banks, when we see that is a borrowed fund, a number of international agencies and developmental banks have emerged over the years of finance international trade. These bodies provide long-term and medium-term loans to promote the development of economically backward areas in the world. These bodies are set up by the government of developed countries. For example, International Finance Corporation (IFC), Exim Banks, Asian Developmental Bank. These are the private banks which are also helping the companies to raise the capital through the way of different sources. So these bodies provide long-term and medium-term loans to promote the development of which area, especially that is economically backward areas in the world. Okay, so that is the main target of international agencies and developmental bank. That's why the bank's name is also developmental bank, because not only the way to provide finance but also to make the development of the area of the part of the world which needs development. So these are the international banks you can see. Next is international capital market. When we see international capital market, student, this is that market which provide international way, like stock market is there, which is providing the source of finance from the Indian market, but international capital market is that which will provide you the source of capital from the international source. Modern big and multinational organizations get themselves listed on the foreign stock exchange. Okay, and the common financial instruments used for this purpose are like shares and equity shares of our country. If we want to issue, we will be listing not in foreign stock exchange, we will be listing in our country's stock exchange. Like there are various stock exchange market, Mumbai stock exchange, Delhi. So area wise, whichever stock exchange is there, we will register our company there, and there, from there we can issue our shares to the general public or to whomsoever we want to issue. But international capital market, the people have to list their name in the foreign stock exchange, and the common financial instrument used for this purpose are very first GDR, Global Depository Receipt, Owners Fund, long term. Global Depository Receipts are issued against issue of equity shares in the global market. If the company want to issue their shares to the foreigners at a very high rate, then they can go through the Global Depository Receipt. These are indirect equity offerings. The equity shares issued against GDR are held by an international bank called depository. Depository is that bank. See here, student, there must be some proof and evidence that transaction had been done by the shareholders to the company, and from company dividend has been paid to the company, to the shareholders. For that trustee, what is there? There are some banks which are considered as depository. Companies issue dividend notices, reports, etc. through this only. Regarding these shares to a bank only, these shares are called depository shares. The holders of this share do not get voting rights. The capital contributed by these shares is in dollars. That is why these are called dollar denominated instruments. The global depository receipts were introduced by the Citibank in 1990. Main features of GDR when we will be going to learn. Very first is capital collected from the issue of GDR is in foreign currency. Definitely it is an international source, so currency will be international level. The issue price of GDR is fixed on the basis of investors' response. No voting rights to the shareholders of the GDR. GDRs are easily transferable at the stock exchange. The first Indian company to issue GDRs was Reliance Industries. It sold $150 million worth of GDRs in 1992. Next is American Depository Receipt, that is ADR, Owners Fund, long term. And ADR is just like a GDR, student, except that it can be issued to a citizen of United States of America. It means only to American. If India want to issue the shares of ADR, then it will issue to only to America, that is a citizen of USA only, and it can be listed in the US stock exchange. Shares issued by the company are held by the international bank called depository. Their banks will not be Indian, it will be an international bank, which will be now the depository and do the same work has and done in the earlier GDR, which receive dividend notices and reports. ADRs are subject to much restricted disclosure requirement and than GDRs, because regulations of US stock exchange was very strict. Annual legal and accounting cost of maintaining an ADR is much higher than GDR. An ADR is an American dollar denominated instrument. Any American bank functioning as a depository can issue the ADR. IDR, when we see, students, owners fund, long term fund. And IDR is also like GDR, except that it is issued to citizen of India itself. Through IDR, foreign companies raise funds from Indian market. Like our country want to issue the shares of and want to raise the funds from America and the global areas by GDR and ADR. Same way, from India market, if anyone want to invest in foreign companies so as to get profit from that company, they can do through the way of IDR. Through IDR, foreign companies raise funds from Indian market. The foreign companies' IDRs will deposit shares to an Indian depository. The depository issue receipt to investors in India against these shares. Standard Chartered Banks was the first global company to file for an issue of IDR in India. Eligibility of companies to issue IDRs are as follows. Very first, the issuing company must be listed in its home country and is not prohibited to issue securities by any regulatory authority. It has net tangible asset of at least 3 crores in the 3 years continuously in the past. It must have net worth of rupees 1 crore in each preceding 3 years. Definitely then only the 3 years in the continuous class. that company eligibility of companies must be there for issuing IDRs. Okay, so the issuing company must be listed in its home country, means there, like any foreign company is there, in their home country they must be listed in their stock exchange, then only they will be getting it is not prohibited to issue securities by any regulatory authority of their company, then only they can issue in India their shares. Reservations in IDR issues, at least 50% of the issue is to be allocated to qualified institutional buyers, 30% of the issue to the retail individual investors, and balance 20% of the issue to non-institutional investors and employees. Factors kept in mind before selecting a suitable source of business finance. Very easy, student. No source of business finance is free from limitations, so we cannot say which is the best source of finance. Some will be there. Cost involved. If we cost mind you will be seeing, then more cost is involved when we issue the shares as compared to if we are taking borrowed fund, because borrowed fund legal formalities are very less. Before finalizing any source of finance, the company must find out the cost involved in procurement of fund and cost involved in using the funds. Both the cost must be less than the benefit which they get by using the source of fund. Financial capacity of the firm. If the firm's financial capacity is sound, then they can prefer borrowed fund. But if financial capacity is weak, then they must issue the shares and they must increase the finance through the way of equity and preference shares. It will be beneficial, because if financial capacity is not good, then there can be risk of payment of rate of interest and the principal amount. Forms of business organization. Sole proprietorship firm and partnership firm cannot raise fund by issue of shares or debenture, so they will be taking borrowed fund. But whereas stock companies, they can have the shares or other borrowed fund. Time period. Another factor which helps in deciding the source of fund is the duration for which the time firm requires fund. As per a short period trade credit, factorizing, short term loans, etc. are suitable, whereas for a long term shares, debentures are suitable. For a medium term public deposit, loans are suitable. Risk involved. Owners fund securities involve no risk, whereas borrowed fund securities are risky securities. If a business firm can bear the risk, then only it should go for borrowed fund. Otherwise, it should prefer owners fund securities. Control point of view, equity shareholders, if there are if they find the dilution of control with other new members, then they can issue more equity share. But if they don't want to make dilution of control with other members, then definitely they will prefer borrowed fund. Flexibility point of view, sometimes a financial institution which provide long-term debt to companies put certain restrictions on the companies which restrict the flexibility of the company. So there they can have the issue of shares instead of borrowed fund. Claim over the assets. Some source of finance mortgage the assets of the firms and reduce its credit worthiness. So it will not be good for the companies, like debenture, secured loan. Companies most often they must not take the not raise the finance in the form of debenture, secured loan. Instead of that, they must think about shares, unsecured loans, etc. So that do not put claim over the assets, hence result in no reduction in credit worthiness. Tax benefit. If tax benefit you want, dividend is not deducted from the income of the company. Tax is deducted and after the tax is charged. So that point of view, if we are seeing interest on debentures, loan is deducted from the total income of the company before calculating income tax, whereas dividend paid to equity shareholders is not deducted from the total income. So if a firm wants to get tax deduction benefit, it must prefer borrowed fund, but if not, then they must prefer shares and other types of things. Thank you for today's class. Have a nice day. This chapter gets over. In the next class, we will start the next chapter. Thank you for today's class. Have a nice day.